In this second part of our deep dive into the Q3 2025 U.S. banking results, we're focusing on three Wall Street heavyweights: JPMorgan Chase, Citigroup, Goldman Sachs, and finally we'll talk about the comparative ranking, best to struggling. These banks set the tone for the financial sector with their massive scale, diverse operations, and bold strategies. Don't miss this crucial analysis to stay ahead of the curve. Hit subscribe and get ready for the inside scoop on Wall Street's biggest banking showdown.
Yeah, it's going to be interesting.
Our mission today isn't just to report the earnings numbers. We're digging past the glossy headlines to understand the underlying stories, where the actual momentum is coming from, and critically, what management teams are signaling about potential risks, going into the next cycle.
Exactly. And when you look at these three giants, macro conditions are forcing them to lean into very different operational strengths. It's leading to, pretty divergent results, even in what looked like a strong quarter overall.
Okay, let's start with the biggest of the big, JPMorgan Chase. They are like the definition of financial strength, and their Q3 results really underscored that dominance. What does the sheer scale look like this quarter?
The numbers are just massive, as you'd expect. JPM reported managed revenue of $47.1 billion. That's up 9% year over year.
Wow, okay.
And that robust top line flowed right down to net income of $14.4 billion, which is an increase of 12% year over year. That delivered diluted EPS of $5.07, up 16%. So strong growth across the board.
And the ultimate proof of their efficiency profitability, that return on average tangible common equity, the ROTCE metric everyone watches.
Right, the ROTCE. They delivered a top-tier annualized ROTCE of 20%. That's, really setting the standard.
20%, that is impressive. But where did that strength fundamentally come from? Was it one particular area?
Well, the engine was clearly non-interest revenue, or NIR. That grew 16% year over year. And if you look under the hood of NIR, the commercial investment bank, the CIB, was simply outstanding.
Okay, the CIB. So we're talking trading investment banking. Did they really capitalize on the market rebound we saw this quarter?
They absolutely did. CIB net income surged 21% year over year. Their markets revenue, that includes fixed income, currency, and commodities, FICC, and equities, it hit a record third quarter high of $8.9 billion.
Or a record high.
Yeah, surging a massive 25% year over year. Investment banking fees were also very robust, up 16% year over year.
So high activity, great fee capture. But JPM isn't just Wall Street, right? How did the Main Street side, the consumer and community banking, CCB, how did that fare?
Yeah, the consumer performance was very strong, too, really confirming their franchise power. CCB net income is up 24% year over year.
24%, okay.
They added over 400,000 net new checking accounts, maintained their number one rank in U.S. retail deposits. Even asset wealth management income grew 23% year over year, fueled by, get this, $109 billion in net inflows.
Wow.
The diversification truly works for them. It's a real strength.
Okay, given all this green across the board, were there any specific points of weakness or maybe, let's say, caution that we should flag for the listener?
The main headwind was definitely credit costs. They were elevated at $3.4 billion for the quarter, and that included an $810 million net reserve build.
A reserve build, okay, so anticipating potential issues.
Exactly. And specifically, they called out elevated wholesale charge-offs. This was due to two instances of what they termed apparent fraud, including a pretty large $170 million charge related to the Tricolor situation.
That $170 million fraud hit, does that suggest a crack in the fortress? Or is that just, the unavoidable cost of doing massive, diversified business in this kind of environment?
Well, management appears to view it as more idiosyncratic risk, a specific failure rather than something systemic.
Yeah.
And maybe the encouraging sign for the macro picture came from the consumer side.
Oh, yeah. What was that?
They noted ongoing resilience there. Strong consumer health, leading management to actually lower their full-year card services net charge-off outlook. The NCO rate they're now expecting is approximately 3.3%.
Lowering the NCO outlook, that's a vote of confidence, isn't it?
It really is. It suggests they see underlying consumer strength despite those specific wholesale issues.
Which brings us to CEO Jamie Dimon's tone. Despite delivering these phenomenal results, repurchasing $8 billion in stock, he remains highly cautious, citing a heightened degree of uncertainty. Why maintain that careful stance when things look so good on paper?
It's classic risk management, really. He reaffirmed the firm's strategy is always to prepare for every possible scenario. He used that famous analogy again.
The cockroach one.
Yeah, the cockroach one. When you see one cockroach, there are probably more out there in the market. So that caution guides their balance sheet strategy, guides their reserves, even when times seem good. It's about being prepared.
That sets a perfect, cautious backdrop. All right, so if JPM represents stability, let's pivot now to Citigroup. This is the classic transformation story, where success is measured not just in dollars, but maybe more in execution risk.
That's the key distinction. Absolutely. So Citi reported total revenues of $22.1 billion, up a decent 9% year over year. NII, net interest income, was up 12%. But, and this is a big but, you absolutely must look past the headline net income number to really understand their performance this quarter.
Okay, why? Let's clarify that adjustment for everyone listening. What exactly dragged down the reported net income?
Right, so the reported net income was $3.8 billion. But that number was significantly reduced by a $726 million pre-tax goodwill impairment charge. This was related to the ongoing sale of Banamex, their Mexican consumer bank.
Ah, the Banamex divestiture. Okay.
Exactly. So when you exclude that non-cash charge, their adjusted net income was actually $4.5 billion.
Okay, that's much stronger.
Much stronger. It's a powerful 38% increase year over year on that adjusted basis. And importantly, that adjustment also lifts their adjusted return on average, tangible common equity, their ROTCE, up to 9.7%.
Almost double digits then, operationally. So, ignoring the charge, where did they achieve the most operational momentum? Where are things working?
They actually achieved positive operating leverage across the firm and in all 5 of their core businesses for multiple quarters now. That's a good sign. Their market segment delivered its best third quarter ever at $5.6 billion.
Best ever for Q3.
Yep. And crucially, their services segment, that's Treasury and Trade Solutions and Security Services, posted its best quarter ever, period, with a truly dominant ROTCE of 28.9%.
Wow, nearly 29% ROTCE in services. That capital-light business is really humming.
It really is. And that stability is highly prized by the market right now. Banking revenue also jumped 34% year over year, and investment banking fees specifically were up 17%. So some good momentum there, too.
Okay, that services performance sounds great, like an operational clean sweep almost. But what about the specific risks Citi is running? We talked about credit costs at JPM. What about Citi, particularly regarding credit quality?
Right. Credit costs were high for Citi, too, $2.5 billion total. This was primarily driven by net credit losses, NCLs, in their U.S. cards portfolio. The NCL rate there hit 4.0%.
4% NCL on cards. That's getting up there.
It is, but perhaps the major red flag, the thing to really watch, appeared in the wholesale book. Corporate non-accrual loans, NALs, they increased 119% year over year.
Whoa, 119% increase year over year. That demands attention. What's driving that?
They attributed it to a handful of idiosyncratic corporate downgrades, specific companies running into trouble.
Okay, but does that suggest that the execution risk of their big transformation, their simplification, is now being maybe amplified by these sudden pockets of wholesale credit stress?
It certainly raises the question, doesn't it? Strategically, though, CEO Jane Fraser confirmed that over 2/3 of the transformation programs are on track, and the Banamex sale is moving forward. But you're right to focus on the risk.
So the whole investment case really hinges on them hitting that target.
Absolutely. The entire investment thesis for Citi hinges on their commitment to hitting that medium-term target of 10 to 11% OTCE in 2026. If they miss that, well, the market discount they currently trade at will likely deepen. It's a tightrope walk.
A clear high-risk, high-reward proposition, then.
Okay.
Let's pivot now to our third heavyweight, Goldman Sachs, the investment banking powerhouse, which delivered, absolutely explosive headline revenue growth.
Explosive is definitely the right word. Goldman reported total net revenues of $15.184 billion. It's a huge 20% increase year over year. It's actually one of the highest quarterly revenue figures on record for the firm.
Really? One of the highest ever?
Yeah, and that propelled diluted EPS to $12.25, which is a stunning 46% year over year jump. Their ROTE, return on equity, came in strong at 15.2%.
15.2%, okay. And that performance was just absolutely dominated by global banking and markets, GBM, right? How high did the IB fee machine crank this quarter?
GBM revenues topped $10 billion. The investment banking fee segment surged an extraordinary 42% year over year.
42%.
Yeah. And this was led specifically by advisory fees that reflects completed M&A volumes. Those rocketed up 60%. Goldman truly capitalized on the rebound in deal flow this quarter.
Capturing that M&A volume is fantastic, but How sustainable is a 60% surge in advisory fees? Are there other diversifiers within the GBM unit that also contributed significantly?
Absolutely. It wasn't just M&A. Their fixed income, currency, and commodities, FICC, net revenues rose a strong 17% year over year.
Yeah.
And equities net revenues grew 7% year over year, driven by record equities financing activity, which jumped 33% year over year.
Okay, so strong market activity boosted pretty much everything in GBM.
Pretty much, yeah. Broad strength there.
Now, Goldman's focus has been shifting away from consumer banking strategically, but we still need to look at their other segments: asset and wealth management, AWM, and the relatively new platform solutions, PS segment. How did they do?
Right. AWM net revenues were up a solid 17% year over year, and their assets under supervision, AUS, reached a new record of $3.45 trillion.
3.45 trillion. Okay.
Yeah, massive scale there. Now, Platform Solutions, PS, net revenues were up a very substantial 71% year over year.
71%. What drove that?
Well, that huge jump was primarily what you might call a cleanup effect. It mostly reflects the non-recurrence of a big net loss they took from the GM credit card program back in the prior year period. So what about lapping an easy comparison?
Okay. So less about new organic growth there. Now we've seen credit stress crop up elsewhere. What were the internal pressure points for Goldman this quarter? Any specific areas of concern?
Well, on the expense side, their costs grew 14% year over year. That reflected higher compensation, which is, directly tied to their phenomenal performance.
I pay for performance.
Exactly. Plus, they booked about $131 million in rising litigation provisions. On the credit side, the provision totaled $339 million. And most of that, $286 million of it, was due to net charge-offs within that PS credit card portfolio.
So the consumer credit risk is still visible there.
It is. It's the classic trade-off, right? Pursuing that kind of consumer growth, even as they scale back parts of it, comes with significant and sometimes lumpy credit risk.
Okay, so putting it all together, we have JPM as the consistent dominant leader. We have Citi as the operationally sound but capital challenge turnaround story with significant execution risk. And then Goldman Sachs as the high-growth investment banking star, really riding the market wave. Let's shift our focus now to how the market sees them. The valuation. What are investors willing to pay for certainty versus potential growth right now?
Yeah, that's the crucial question. And when we look at the valuation multiples, we see the market rigorously pricing in exactly those factors: execution risk, confidence, stability.
All right, let's start with JPM then, holding that impressive 20% ROTCE crown. How's it valued?
JPM is valued as, let's say, slightly overvalued. It's trading at a price-to-book ratio, PB, of about 2.56.
2.56 times book. That's a hefty premium.
It is. And that premium is a direct reflection of their superior scale, their proven execution track record, and just high investor confidence in their CIB leadership especially. Essentially, you are paying extra for the stability, the perceived safety of their dominance across economic cycles.
Makes sense. And what about Goldman Sachs, riding that incredible 46% EPS wave this quarter?
Goldman is also considered overvalued, maybe even more so on an earnings basis. It has a high-priced earnings multiple, PE, of around 15.25.
Okay, so why the premium there?
The market premium here reflects, I think, real optimism about the sustainability of their investment banking momentum, and also a belief that they are effectively managing their expense base and restructuring that platform solutions segment to limit future losses. Investors are betting the growth continues.
Okay, which leaves Citi trading below book value, clearly the outlier here.
Citi is the clear, slightly undervalued firm among these three, trading at a price-to-book of just 0.96, basically right at book value.
Below 1 times book. Why the discount?
Well, the discount reflects deep market skepticism about the execution risk we talked about, the risk inherent in their huge strategic restructuring. And of course, the negative drag on reported earnings from that goodwill impairment, which dropped the reported ROTCE down to just 8.0%.
So it's a value play, but with big ifs attached.
Exactly. They are a value play, but only if you believe they can actually hit that critical 2026 ROTCE target of 10 to 11%. It all comes down to execution.
Okay, for some quick context, how do these multiples stack up against, say, a big, balanced universal bank like Bank of America and maybe a pure custody bank like BNY Mellon?
Good comparison. Bank of America looks fairly valued right now, with a PB around 1.43. The market sees it as a robust, balanced universal bank with pretty solid expense discipline, predictable, stable. On the other hand, BNY Mellon is seen as overvalued at a PB of 2.06. They are getting highly rewarded for their specialized capital-light custody model. That model delivered the highest ROTCE in the entire sector, this quarter at 25.6%.
25.6%. Wow, that explains the premium.
Yeah, the market loves that stable, high-return, low-capital business model.
Okay. Finally, we noted some specific stress points at the majors, like fraud or card losses. What's happening more broadly, maybe in the regional banking space? Are we seeing similar stresses?
Well, the regional banks are definitely showing some significant idiosyncratic issues. It's not uniform, but banks like, say, Fifth Third, FITB, and Comerica, CMA, they're seeing their valuations impacted by major specific credit impairments in some cases, or persistent struggles with efficiency and declining core revenue in others.
So the stress is real, but it's hitting different banks in different ways.
Exactly. It's manifesting very unevenly across the sector right now.
All right, so to bring this all together then, JPM continues to be the undisputed, rock-solid leader. Goldman Sachs is the high-growth star, really capitalizing on M&A and market activity. And Citi is the complex turnaround story where success is entirely dependent on flawless execution against a backdrop of, well, increasing credit risks, it seems.
Perfectly summarized. And this brings us right back to Jamie Dimon's cockroach comment, doesn't it? We saw specific, large-scale credit stress points in Q3 across all these major players. The apparent fraud at JPM, the severe NAL increases at Citi, high card charge-offs at Goldman Sachs.
Right, pockets of trouble everywhere.
Exactly.
Yeah.
So the provocative question for you, the listener, to think about is this. If this idiosyncratic credit stress is surfacing and actually hitting earnings while the market and the economy are still relatively strong, what happens if economic conditions do tighten more broadly? How well can even these fortress balance sheets absorb the next round of potentially widespread credit losses, maybe in Q4 or heading into Q1 2026?
That is a crucial thought to chew on as you consider the entire sector going forward. Thank you for joining us for this deep dive today.
We are not certified financial advisors, and this content is only for educational purposes.
If you are considering making any investment decisions, please consult a certified financial advisor.